Hey everyone, Brian Bogner along with Greg Towner here, and we are excited to talk to you today about this topic, which is, are we in a bubble? It's been dominating the investment headlines, it's been dominating the news that we're in an AI bubble, the market's in a bubble, it's going to crash, it's going to come down. And so we want to take the next 20 minutes in this breakdown and give you our thoughts on this, make some comparisons back to 2000, which that's where a lot of the headlines are right now, and talk to you. So let's go ahead and get started. Uh, there we go. So Greg, and this is very different. Normally when we do this, right, it's just you and I talking back and forth, but we think it's really important to show some data points, show some slides on this one here. So if you're just listening to this, I'd say if you can, throw this on YouTube, watch the slides because there are some data points in here we're going to be talking through that I think are very important. But let's start with this question, Greg. What is a bubble?
Yeah, thanks, Brian. We definitely need to try to define this. I think everybody might have a little bit of a different perspective on how to define it, but I mean, really, you're looking at just a really rapid price increase, usually to what most people consider value, very high valuation levels. People claiming, oh, it's different this time. We're in a whole different period. You don't understand that sort of thing. Inexperienced investors that, haven't invested much in the past, just kind of rushing in, driving sentiment to really euphoric type of levels. And then, investors buying assets really for the primary or sole purpose of just hoping to sell them later at a higher price rather than any like fundamental reason of owning. So I think, you could probably say for all of these right now, there's at least some way to make an argument that maybe we're in a bubble. You can talk about it either way, as we will do over the next 20 minutes.
Right, there's definitely signs of this, no doubt, right?
Mhm.
And so we very well could be. So and we certainly know the news headlines are
Yeah.
definitely jumping on this right now, right?
Yeah, this is the mentions in the news about AI and bubbles and over the last few years. You can see it's spiking here lately, as it has done a couple of times here in the last couple of years. I mean, I like to say, and I've heard others say, we're kind of in a bubble of people talking about bubbles right now. So everybody wants to talk about it, which, sometimes that means it's not necessarily happening, but we'll get into that.
All right, so I think one of the comparisons that we're seeing a lot is taking the dot-com era, right? When we say dot-com era, what we're talking about is late 90s into 2000, which, if you remember then, the market entered almost 3-year bear market into March of 2003. So does this area compare to 2000?
Yeah, let's look at a bunch of charts going over that. This first one is a look at the PE valuation going all the way back to that period. You can see during the dot-com bubble, it got up to around 50 or so. The chart's a little distorted by the great financial crisis because earnings briefly got so depressed. But if we focus more on this current period now, we're kind of in that upper 20s to 30 range. Not cheap by historical standards by any stretch, not going to make that argument. But if you're just talking about comparison to the dot-com period, which a lot of people are doing, we're certainly not nearly as stretched as that period.
Yeah, yeah.
Yeah.
Okay.
Now, I think this is important. A couple of charts here, Brian. So what we're looking at on the left is the global technology sector performance during that dot-com period leading up to and after. The red line is looking at the actual price movement of that global tech sector. It's huge, huge spike higher up there. Whereas the blue line is the actual earnings for the global tech sector, fairly steady and nowhere near as high up. So they did not track. Price got really far away from the actual earnings. But the chart on the right looks at this current period. Again, red line talking about the actual price movement of tech, the blue line, the earnings. You can see we've been tracking very well. Maybe in the very short term, price is a little extended. That's just kind of minor details. So, yes, of course, earnings could roll over and stop growing at this rate. That's a possibility. But for the time being, anyways, price has been justified by the actual earnings themselves.
Yeah.
Another key point that I think is different, Brian, than the period that we started our careers in .com. I mean, you remember that period. There was all kinds of speculative things, pets.com and all this stuff that had, I mean, forget earnings. A lot of them didn't even have revenues,
Right,
real
right, exactly.
speculation.
Yeah, yeah.
And so what you see now with a lot of companies, this chart looks at the top 500 median free cash flow yield. So, the free cash flow that they're generating, it's a good look at quality of companies and valuation. Our yield, the higher the number here is better, about 3.5% now in the median stock. Back in the dot-com period, it was only 1.2. So from that measure, health and valuation measure, things are much better off now than back then.
And you got to remember too, coming out of the uh, dot-com period, there was a lot of financial shenanigans going on with the reporting, and a lot of regulation came out and required companies to, have certain standards when they report. So if you notice, the cash flow yield has actually been higher since
Yeah.
that period on average, and I think there's also been some regulation around that as well. The companies aren't able to hide things and do some of that stuff like they were.
I think another way to look at how companies are just of better quality now, not only compared to the dot-com period, but just historical. If
Hmm.
you look at the beginning of this chart, this looks at S&P 500 profit margins, net profit margins. They were typically, say 5% or so for many decades. And then with the advancements of technology and productivity in the 90s, they improved to maybe call it 7% or so. And now it's continued to move higher. And we're all the way up to around 12% in net profit margins. Now, if you look at just technology, it would be even much better than that. But I think, again, this can justify some of the valuation numbers. Maybe not all of them. I'm not saying it's, we're cheap by any stretch. But comparatively to history, I mean, go back way back over history. What did the US do? It produced manufacturing, really high fixed costs, dirty, expensive things that required lots of employees and costs. Now, so much of what we do is, service related, technology related, and all of that. Better profitability for a lot of companies.
Yeah, I mean, again, this is if you look all the way back to the early 90s, I mean, this is technology driven, right? It allows
Sure.
companies to be more productive. It allows companies to do more things with less, and AI is going to do that again, even more so, right? Let's be
Right.
honest. It's just
Yeah.
that's what's going to happen.
Well, I like this chart because it's looking specifically at the technology sector, and it's a 12-month rolling price return going all the way back to the 90s. And you can see there during the dot-com period, a number of rolling periods where returns were really extended in that kind of 100% 12-month rolling range. I mean, that's just not realistic and sustainable. We've had a few other periods where it was about 75% over time. Again, that's not sustainable. Well, right now, where we are, as of I think this chart's maybe a week or two old, under 30%. Now, that's still good, but it's nowhere near the astronomical levels that we have seen
Right.
over time.
You got to remember that though that these three other areas that happened were coming kind of out of some bear markets. You know what I'm
Sure.
saying? So those initial returns coming out of the bear markets were extremely high, and that's what you're getting here. But this was back in the late 90s, this was coming out of a bull market that these things were happening. It was really a blow off top, right? And we're
Right.
not seeing that right now. Returns are great and they're good, but they're not like to those degrees back then. Yes.
Right. Exactly. Now, one thing that I think is not getting enough attention about the difference between this period right now and back in the dot-com period. So on the left-hand side of the chart, at the bottom there, the red is short-term rates, meaning 2-year yields. Yields were increasing as we were leading into the end of that technology bubble period. The Fed was raising rates, yields in general were going up. I mean, that all else equal is a headwind for risk assets and reduces liquidity that is so important. Whereas right now, I think most people are aware the Fed is, starting to cut rates, general rates,
Mhm.
2-year, 5-year, 10-year, and so forth are starting to come down, not dramatically so, but modestly so. And if they were to continue that, that's, very arguably a tailwind for risk assets,
That's right.
at the very least, not a headwind. So that's a hugely important difference between now and the dot-com period.
Yeah. Nobody wants to talk about boring old interest rates, but they drive everything.
They drive a lot, absolutely. Well, these next couple charts aren't necessarily comparisons now in the dot com, but I think they're good overall looks at, why the market may be doing what it's doing. This looks on the far left at the US compared to other regions of the world. It's looking at return on equity, how much companies are making on basically what they're investing in their business. The orange dot shows how much higher than historical norms the US is right now on its return on equity. Now, sure, somebody could say, well, that's not sustainable. And that may be, we'll only know in hindsight. But the reality is, for the time being, again, that's a justification, just like with the profit margins, why these valuations are what they are. If you're making more money, if you're needing to use less money to make more money, basically what this tells you, you can justify higher valuations,
And this is why valuations continue to be a horrible timing tool.
right?
Valuations matter, but what, if and when this decides to correct to some mean or something like that, we just don't know. And so there are reasons why things stay overvalued for a while. There are reasons why things stay undervalued for a while. It's not a great timing tool.
Well, this is a chart, I know it's a little bit hard to see, so I'll just kind of explain it. It's a 3-year chart, which actually happens to align with the bear market low of 2022.
Mhm.
Brian, as an aside, a lot of people forget that 2022 was a bear market.
Fair market. Yeah.
The S&P at its worst was down 25%.
Right.
QQQ is down 35%. So that kind of reset a lot of things there.
Mhm.
Well, this looks at the past 3 years, and I'll just say at the top, those three indices at the top. The blue, I believe, is the QQQ. Let's use that as a proxy for technology. Yes, really, really strong returns. That's kind of what everybody's talking about might be in a bubble. But above that, in the gray, actually, gold has returned more than technology during that period. And some people are starting to maybe call that a bubble, but not nearly as much. The orange, just to pick a random industry, well, maybe not random, but another industry, aerospace and defense has returned essentially the same as technology. You don't hear anybody talk about that being in a bubble. And just like back in the dot-com period, there's lots of other areas that are doing okay, but not incredible. The S&P itself, value is underperformed. Small caps have really underperformed. I read a statistic the other day that the median stock right now is in a 13% drawdown still, after the April volatility. So, we know that we saw during that dot-com period a lot of areas get beat up coming out of it, but it also created a lot of opportunities for rotation to other areas. So we're seeing, whether it be areas that are benefiting from AI, like utilities and that sort of thing, or just opportunities in general for beat up areas that are definitely not in a bubble. Well, let's forget about necessarily the comparison between now and the dot-com period, but let's look at a chart that looks at this bull market, again, starting it from 3 years ago when that bear ended, compared to other bull markets going back to the 70s and 80s. The y-axis on the left looks at the percentage return, the x on the bottom looks at the time period. We have not gone nearly as far in time or in price as any of these other past bull markets. Some of them went much, much longer and higher,
Mhm.
others, more modestly so. Every time is different. I mean, a statistician would tell you this is a small sample size. We would tell you past returns and no guarantee, et cetera, et cetera. But if you're just looking at, this chart and you think this has been a bull market,
Right.
I mean, it would be pretty unusual for it to end all of a sudden right here at this level.
Yeah. Yeah.
I liked these, I think there's a lot of different ways to argue about whether this is a bubble or not a bubble or what have you. And so I pulled a couple of these recent quotes that I think is pretty interesting in my opinion. The first one here, are we in a phase where investors as a whole are overexcited about AI? My opinion is yes, this person says. Is AI the most important thing to happen in a very long time? My opinion is yes. That is OpenAI CEO Sam Altman. They're the owner of ChatGPT. So he's kind of talking out of both sides of the mouth. Yeah, we're in a bubble, but it's, maybe justified is kind of maybe what he's saying there. They're, of course, at the centerpiece of this. Another maybe a little bit lesser known company, but very much at the center of all this. This quote literally comes from this morning in their earnings report. Our conviction in the AI megatrend is strengthening. AI demand is stronger than we thought 3 months ago. This is from Taiwan Semiconductor. They make 90% of the advanced AI chips. They
Right.
said they see growth continuing at greater than 40% per year because of the overwhelming AI demand. So demand is there. How sustainable is it? Time will tell. Is it a bubble?
Yeah.
Time will tell.
So, I think that, all right, so we basically have, I think we've done a good job saying that, and you've done a great job, Greg, saying that AI this AI bubble that everyone's talking about really doesn't look a lot like what happened during the dot-com era, and I think we've showed a lot of data around that. So what does that mean? Okay, here we are today, October 2025. Like, how should we be looking at this, and what should we be doing on this, and what are some potential outcomes?
Yeah, I think everybody right now, you know how these days everybody's like, oh, that's the best, game I've ever seen, or that's the best movie ever. Everybody wants to immediately tag something as the best or whatever. It's
Mega,
kind of,
mega this or mega that or whatever.
yeah.
Yes.
Yeah, this kind of feels the same. Like everybody just wants to, call this a bubble, or we're going into a bubble, or we are a bubble.
Right.
Well, why does that have to be? Why do we have to be in a bubble or going into one? Why do we have to crash from this so-called bubble? I mean, stocks don't have to just surge. That bar of the dot-com period, that's a very high bar to set. That was an unbelievable astronomical return for stocks, much, much greater than right now. So I don't think, people should just focus on a bubble or not. Stocks very well. I know you've made this point, Brian, many times here recently. Stocks could very well just kind of bounce around in some range. It could be a wide range for some period. That's going to frustrate the people that are both bullish and bearish, right?
Yeah, I mean, if you think about the housing market, right? That coming out of COVID in 2020 when housing prices were just going up. Well, the past couple of years in the housing market, prices have stayed high. But if you bought a house a year ago and you're trying to sell it now, I don't think you're cashing in on this big return like you were just 4 or 5 years ago. So it's the same way in the stock market. Just because things are up and elevated and things like that, I mean, we just might have a healthy market moving forward. We might have a sideways market moving forward. We might have a correction. Oh no! Oh dear, a correction. Like we might have a correction, right? I mean, maybe stocks pull back 10, 15, 20% in a normal correction. We just don't know. But what we do know is that there's enough data points to justify that this market is moving forward, and there's a lot of opportunities out there, right? It's not just, well, we just got to own all the AI stocks and that's it, and we're going to be taken care of. There's a lot of other ways to do this. There's infrastructure projects going on. There's energy. There's just a lot of other things happening, right? And that's what we do here at Parallel Portfolios is we're looking at all of the opportunities out there, and making sure that we've got exposure to those things. So, um, any last thoughts, Greg?
No, I think that's great. And I'll just kind of refer back to that chart we showed how this bull market may not be all the way extended compared to the other ones. Just to kind of reiterate what you said, it could just be a normal, healthy, it could be a normal stock market. It doesn't have to be something crazy in either direction. I think people should just kind of focus in, like we talk about, on what is the best for them. What portfolio can they stick with? What financial plan can they stick with? At the end of the day, that's going to get you to your goals.
That's probably why our videos don't get all of the views that we would like them to, Greg, is because we're not pounding the table here with some headline of like
Some hot take.
mega AI bubble crash going to happen and wipe out all your wealth. Like that's not our deal, right? Because that's what
Right.
gets the clicks and that's what get the views, and that's why you see a lot of this stuff out there. We're just trying to show you data points here because we have to manage money and we have to do things here on our end to manage risk and look at all of these things here. So if you have any questions, we'd love to hear your thoughts on this as well. Give us a call. Shoot us. These are our email addresses here. They go straight to us. Shoot us an email. Give us a call. We'd be happy to talk with you on this. And so thanks so much for watching and listening today. And as always, we will see you next time. Have a great rest of your week.